Hello everyone, Kate with Zuna. It's Friday. Hope everybody's having a good trading week so far. Last day of the weekend. Wanted to address a question that we often are asked, and that is how can we tell the difference between chop and days that move? Essentially, what these questions are asking specifically are days that move like this compared to, for example, days that move that the range is so narrow. Okay. This is quite important for those of you that are trend traders that are looking to take advantage of trends. Very, very important for those, and it's at the same time important just about for any trader because when we shorted this area here, but we did that in NQ and not in ES, uh, we needed to know how far can we let our trade go. In other words, what our potential expectations for profits would be. So assuming we went long here, the same thing would be true. On a day like this, to have this type of expectation on this day would be unrealistic, and you wouldn't meet that goal, and most likely market would pull back and take your stop out. Okay. On a day like this, it would be realistic, but most traders, and I've met traders that have been trading for 6 months or all the way up to 6 years. I actually met a trader, talked with a trader about 6 months ago who's been profitable for 5 months, and he came to me with his statements in hand and showed me. So we took a look at his trades, and his main problem was how can I know when to let a trade run? He's like, I have no problems with entry. I have high probability entries, no problems with discipline or anything. I just need to know when to let trades run and when to hold them. And that is a very important fundamental question for anybody that trades. And the fact is that these markets are ruled by, particularly E-minis, but just about a lot of futures are ruled by institutional traders. Majority of the volume is from them, and therefore they control these markets. When they participate, the markets move. When they don't participate, the markets don't move. So since we can't call them and ask them when they're going to participate, the next best thing is to have a volume indicator. The other thing that moves the markets are economic reports. When those reports come out, they bring in a lot of participation from a lot of different firms. And again, so that's another indicator. So two indicators you could use. Some sort of indicator that measures volume, and I'm not referring to a volume histogram where it has a moving average on it, and it's just, most people will use a 50 look back moving average because that is not going to cut it. 50 period look back is not going to cut it. That will not show you anything. Um, but you do need some kind of indicator that will show you the relative volume of today in comparison to past. Another indicator is quite simple, and you can find it on the web. Just use the economic calendar. Let's take a look at this week, Monday. As you can see, all of these are treasury related, and it's 6 months, 3 months, 4 week bills. They're not very important in terms of moving the market. 2 year note is important for the treasuries, but it doesn't really affect the index futures that much currently. It may at certain times when there's cyclical, when it's very relevant, but currently it's not that important. So this is a very light day. Expect the markets to be boring or dull. A little bit heavier, but still light. A little bit heavier, still light. Thursday and Friday were the obvious days. I mean, you could tell that last weekend you could look at this and say, okay, Thursday and Friday are the days that are going to be the best days for trading, and the second day would be Tuesday, just because we have Geithner speaking late in the day, but we also have consumer confidence at 10 o'clock. And then you can do this for next week. So what is today is the 1st, we're in October, let's go to the 4th. And you can see that Thursday again is going to be a good day. Friday in the morning will be good. In the afternoon, it's going to taper off. Tuesday is going to be the lightest day next week. Monday, since we have this pending home sale index, that'll be a good day. Again, in the afternoon, you can see, but this should get things rolling. Should be a decent day Monday. ADP report, petroleum, which does affect the E-minis, but not as much since since crude has been kind of ranging. It's not trending like it was the past 3-4 years. So these 2 days are going to be your lighter days, the afternoon and Friday. So that's one indicator. The other indicator is what we call a relative volume ratio indicator. Let's take a look at the 27th, which is Monday. It's gray and it's very, very low. Dull day. Very, very high in contrast to Monday. Okay, nice day. Gray but higher than Monday. Still okay, very, very high. Look at the move. Okay, today again, it's not as high so far. It's not as high as yesterday or uh, Tuesday, but it is high and it is yellow color. And in the morning when we opened up, where it was kind of choppy, it was gray and very low. Everyone was waiting for this report to come out. So as soon as that hit, there was a lot of participation and the markets began to party. And right now it's tapering off, but it is during lunchtime. So that's basically the two indicators that I personally, and actually we use these indicators: economic calendar, simple, and relative volume ratio. So when we see a high relative volume ratio, for example, we've got short around this area right after the market, but we got shaken out because the volume was so low. Okay, we got shaken out on this spike back up. And once we got the spike back up and we started seeing relative volume indicator move, then we got short, and then we said, okay, now we can anticipate the market to break and give us a big move. Okay. Same thing here when we shorted, this is ES, but when we shorted NQ at the highs yesterday, we were greedy and we held to around this area. Somewhere around this area we covered. I think this is a trade I took on, and in any case, you guys get the point. So broad participation by institutional traders, which are from basically proprietary trading firms, heavily involved in the markets via program trading and other sorts of trading. Those are the people that move these markets. And if you can read their footprints, you'll be able to tell when you should hold your trades, when you should be more aggressive or trade larger position size, and when you should be less aggressive with smaller position size and also have lower expectations for your profit targets. Enjoy your weekend, guys.